The regular U.S. stock market session is currently closed. Applied Digital Corporation, trading under the NASDAQ ticker symbol APLD, officially closed its last regular trading session at $39.52 per share on Wednesday, May 20, 2026 at 4 p.m. Eastern Time, marking an intraday surge of 7.92% before climbing an additional 7.67% in after-hours trading to sit at $42.55. While the broader trading community focuses heavily on big-name tech assets like Nvidia stock, Apple stock, or Tesla stock, the underlying physical architecture making high-density computation possible is undergoing a monumental transformation. The latest numbers show that Applied Digital has successfully signed a massive 15-year take-or-pay lease agreement with a major U.S.-based investment-grade hyperscaler for its brand-new Polaris Forge 3 campus, a development that instantly locks in an estimated $7.5 billion in base contracted revenue, scaling up to a staggering $18.2 billion if renewal options are ultimately taken. This single announcement effectively validates the entire corporate pipeline, showing how digital infrastructure providers can rapidly expand when backed by long-term commitments. Retail trading accounts on major platforms like Robinhood or through traditional accounts via Fidelity Investments are seeing high trading volumes as market participants scramble to dissect what this multi-billion-dollar commitment means for the valuation models of modular data center builders over the coming decade. The overarching expectation surrounding infrastructure builders in this space is that demand will eventually cool off as major tech firms construct their own localized computing facilities. Investors logging into their individual brokerage accounts or checking their Interactive Brokers platform frequently assume that mid-tier server hosting firms will get squeezed out by sovereign clouds and multi-trillion-dollar tech companies. The reality, however, is that building specialized data center facilities require access to immense pockets of utility power and sophisticated thermal management systems that major tech companies simply do not have the time to build from scratch. Applied Digital just proved that high-density computing assets are so highly sought after that hyperscalers are willing to commit to 15-year contracts long before the facilities are even operational, which completely challenges the bare thesis that high-performance data hubs will become commoditized utility spaces. When you look closely at the intraday swings and massive volume spikes hitting the tickers on modern investing sites, you can see a clear divergence between technical sentiment and structural fundamentals. Day traders relying on automated advice or managing assets independently through options platforms often treat infrastructure companies like high-beta speculative proxies, but institutional block purchases tell a completely different story. Major investment entities, from traditional asset managers utilizing a Fidelity brokerage or Fidelity Wealth Management to algorithmic strategies executed on an Interactive Brokers account, are increasing their structural positioning because of contracted revenue security. This massive injection of capital is visible across daily order flows, showing that long-term funds view the contracted revenue stream of $31 billion across 4 separate campuses as an absolute floor for corporate value. For everyday users trying to self-invest or seeking online investment advice through digital platforms like SoFi Invest or Schwab Intelligent Portfolios, parsing through this extreme volatility can feel incredibly overwhelming. A stock that experiences double-digit daily swings requires deep structural understanding rather than reliance on short-term technical indicators. High-growth infrastructure plays are incredibly sensitive to macroeconomic variables, interest rate expectations, and the cost of capital. When institutional desks run calculations on an Interactive Brokers trading setup, they look directly at how much capital is required to build out these multi-hundred megawatt facilities, which means that corporate liquidity moves the stock just as much as a new lease announcement. Applied Digital recently addressed this exact constraint by locking in a $300 million senior secured bridge loan facility from Goldman Sachs, providing the immediate financial runway required to advance construction schedules on these massive capital-intensive projects without severely diluting existing equity holders before the facilities start producing operational cash flow. Let's pause right here, because understanding investor sentiment is vital. Comment below how many shares of Applied Digital you currently hold in your portfolio, or if you prefer sticking to larger blue-chip technology infrastructure assets instead. Hearing your perspective on position sizes helps gauge exactly how retail capital is moving. To truly understand why the financial community is paying such a massive premium for this business, we need to strip away the complex market metrics and look directly at what Applied Digital actually does. The company operates as a specialized designer, builder, and operator of next-generation digital infrastructure, specifically tailored for high-performance computing workloads. This goes far beyond the traditional data centers built a decade ago to host basic enterprise websites or standard cloud storage apps. Modern high-density graphics processing units require immense levels of electrical power and generate vast amounts of heat, meaning standard air cooling
methods fail completely. Applied Digital builds purpose-built facilities utilizing proprietary waterless cooling technology and advanced liquid-cooled architectures designed to maximize efficiency and pack as much computing density as possible into a single square foot. This infrastructure layer serves as the foundation for modern artificial intelligence training, high-level graphics rendering, and blockchain applications. Originally operating in the digital asset hosting space under the name Applied Blockchain, the corporate leadership astutely pivoted in late 2022 to address the massive structural undersupply of high-performance computing centers, capitalizing on their power procurement capabilities to capture enterprise clients. This background helps explain why the corporate financials show such a dramatic change over the last few fiscal quarters. Looking back at historical filings, the business model was heavily tied to the volatile economics of cryptocurrency mining hosting, which meant revenues were highly cyclical and margins fluctuated wildly based on global asset prices. The transition to enterprise hosting completely transformed the income statement. In the recent fiscal third quarter report for 2026, the company posted quarterly revenue of $126.64 million, handily beating analyst consensus estimates of roughly $78.48 million, while posting an earnings per share beat at 9 cents against expectations of a net loss. This dramatic financial turnaround is driven entirely by bringing new capacity online and migrating away from lower-margin legacy workloads towards high-value graphic processing unit cloud services. Furthermore, the strategic move to complete the spin-off of their cloud services business into an independent public entity named Chronoscale in early May 2026 highlights management's intent to unlock pure-play infrastructure value, separating capital-heavy asset construction from asset-light cloud software hosting. When building an online investing strategy, analyzing historical revenue is only half the battle. The real complexity lies in projecting future operational capacities against structural headwinds. If you monitor high-growth tickers on a Robinhood app, you are looking at a market cap that is pricing in massive future performance, which introduces a high degree of execution risk. The newly announced Polaris Forge 3 facility is situated on a massive site spanning over 600 acres, but initial operations are not slated to begin until August 2027. This means there is a significant multi-year gap where capital will be continuously spent on physical construction, steel procurement, and grid connectivity before a single dollar of that headline-grabbing $7.5 billion contract is actually realized as incoming operational cash flow. Any supply chain disruptions, delays in local electrical substation construction, or regulatory hurdles regarding power allocation could instantly push back those operational timelines, forcing the company to rely on more debt or equity issuance to fund the gap. This tension between long-term potential and near-term execution brings us directly to the future scenarios that will dictate where the stock trades over the next 24 months. In a best-case scenario, the company continues its track record of disciplined project execution, bringing its current pipeline of 1.2 gigawatts of critical information technology load online smoothly and on schedule. As these facilities become active, the contracted revenues will begin flowing directly to the bottom line, turning the company into an absolute cash-generating powerhouse, with roughly 65% of its revenue completely secured by investment-grade hyperscalers, including its close infrastructure ties to CoreWeave. Under this bullish trajectory, traditional valuation metrics will normalize, and investors using a Fidelity trading platform or managing portfolios via SoFi Investing will treat the asset as a highly predictable infrastructure play rather than a speculative tech stock. Conversely, the downside risks cannot be overlooked by anyone engaged in self-investing. Because Applied Digital trades at a premium multiple relative to some of its co-location peers like Core Scientific, any sign of structural weakness or macro deceleration will cause severe downward pressure on the equity. High interest rates make funding massive data center developments incredibly expensive, and if the broader tech sector decides to slow down infrastructure spending, finding additional tenants for the remaining 1.7 gigawatts of uncontracted power across their utility pipeline could become increasingly difficult. Furthermore, because the business has to continuously issue shares or secure bridge facilities to fund its rapid expansion, net income per share can easily become diluted even as top-line revenue scales up, which is a structural trap that often catches retail investors off guard when they only look at top-line growth figures on standard investing sites. When you synthesize the entire picture, the core investment thesis around Applied Digital centers entirely on whether you believe their physical infrastructure advantage justifies the near-term capital expenditure risks. The stock market narrative expected a slow, highly dilutive construction process that would struggle to compete with massive legacy real estate trusts. The reality is a company that is aggressively securing power assets at a scale that very few independent operators can match, locking in long-term multi-billion-dollar contracts with investment-grade tenants that provide immense structural clarity for future revenues. It is a classic example of how real-world physical assets act as the ultimate bottleneck for digital expansion. Whether you track this asset through Robinhood fraction shares, execute precise options trades via interactive brokers' fees models, or allocate capital across diversified Fidelity ETFs, keeping a close eye on their construction deadlines and quarterly power utilization rates will be the ultimate key to understanding where this infrastructure pioneer goes next. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.